So anyhow, welcome to everybody. Glad you could join us. We're the Fiscal and Economic Issues Group. Big part of what we do is help you to understand what the facts are with regard to what's going on in the economy and what's going on in spending and budget deficits. Help you sharpen your arguments for what you want to discuss and communicate to your audience, whether it's your friends, whether it's blog posts, Facebook posts, Twitter posts, however you communicate with people, as well as, I guess, getting ready to talk over the Thanksgiving table in a couple of weeks. Hopefully you can have those discussions without being too contentious. We're going to start out by talking about the labor market, then the budget, GDP. I'm going to cover those three issues with help from David at various points. We're going to go to inflation, tax expenditures, Biden's plans, and take action. For those of you, if anybody's new, I'm Carl Falstick. I'm a co-lead of this group and have been for quite a few years. And the other co-lead who was sharing earlier is David Doney, who has also been with us for a few years at this point. He's no longer a newbie. So looking at jobs, over the last couple of years, we see that back in February of 2020, before we knew we had COVID, and this is actually the middle of February, we had a peak jobs of 152.5 million. Then we lost over the course of 2 months, 22.4 million jobs. We've been recovering or adding back jobs since then. So we're now up to 148.3 million, which is 531,000 greater than what we had the prior month. We're still down 4.2 million versus this peak, but we're getting a lot closer. And 81% of the lost jobs are recovered. The 531,000 jobs added in October. The total jobs in the October report actually went up 765,000 because there were substantial revisions to August and September. So where it had looked like we had fairly weak job growth in August, September, that turned out to not be the case. Unfortunately, we didn't get this report until right after the November elections in Virginia and New Jersey. It's reported generally the first Friday of the month. We get the prior month's data. And what we see here is that this year, the initial estimates, the lighter blue, have generally been revised up. Now I'm pointing at March, where it's the 1 month where the numbers got revised down. But in general, the numbers have been revised up. And this is not historically, this works out and nets out to zero, but in this particular year, so far, it's increased by 632,000 versus the initial release. The July job creation was revised up by 148,000. So what appeared to be mediocre job growth these 2 months turned out to be, pretty respectable. And if we look, we've added a fair number of jobs. This is a fairly quick recovery from a deep, deep trough recession. These are earlier recessions. This is the Great Recession of 2007 to mid-2009 and how long the recovery took. And this is the early 2000s recession, which was a minor blip on a GDP standpoint, but took had substantial job losses and took 3 years to recover, more than 3 years to recover. And what we're seeing here, price pressures during the current year have persisted much longer than a lot of economists had predicted. And that's a consequence of persistent labor shortages here and abroad and other Delta-related variant supply chain disruptions, as well as very strong demand for consumer goods, so that the demand for goods is higher than it had been prior to the downturn. We were talking earlier, my sister's in Vietnam, and their factories were shut down for a while because they did not have the vaccines. Now they're getting all of their workers vaccinated so they can safely go back to work in the factory, which should help for at least some goods being able to get on the boats. And then, as we were discussing earlier, then they've got to get off the boats to the warehouses. Here we see that percentage of retirees has gone up versus what was happening in the pre-recession trend, as a number of people who lost their job temporarily but were given financial support ended up staying out of the workforce. If they were able to go back to their original job, a lot of them did, most of them did, but a certain percentage of the population, a measurable percentage, have gone ahead and stayed out of the workforce and decided to retire early. So we're getting back to the percentage of older people in the workforce coming down closer to what it was 20 years ago versus what it's been going up in the last 10 years or so. And a lot of that has to do with a perception of risk of older people who may have comorbidities and don't want to go back to working in the office or working in environments like retail, where they have exposure to a lot of people that are not masked, and they put their health at risk. Unemployment rates, obviously, they peaked back in April of 2020 and have been coming down since then, trending down. We're now down to a U3 rate, which is the widely reported unemployment rate of 4.6%. It came down another 0.2 of a percentage point this past month. And the U3 rate is, to be considered unemployed in the U3 rate, you did not work during the month and you looked for work within the prior month. The U6 rate is a slightly broader definition of unemployed. It's you didn't work in the month and you had looked for work sometime in the prior year, plus anybody who's working part-time who wants full-time employment. And so out of the, I'm going to use a number from a year ago or 2 years ago, out of the 27 million people working part-time, about 5 million are working part-time but want full-time employment. So in the U6 rate, we count them as unemployed. But in the U3 rate, they're counted as employed, which is why this is a lower unemployment rate. And here we look at the employment population ratio. And for prime working age people, 25 to 54, we see that it was it actually started coming down before February. It was slightly higher in January, went down substantially and has come back a fair amount, but there's still a fair number of people that went ahead and are still not yet back in the workforce. A lot of them are parents, especially single parents that have to deal with kids that are just now getting vaccinated, the 5 to 11-year-olds, and finding childcare for the kids if they have to, because a lot of the childcare, a lot of the childcare workers have not fully opened up because they can't get staffing for the childcare centers. So between schools not reopening until this fall and childcare, what we had was about, on a seasonally adjusted basis, about 300,000 women left the labor force in September, which probably means that they didn't re-enter when the kids were supposed to go back to school. But then 350,000 returned in October beyond what was normal. So we had a delay in terms of women re-entering the workforce. So it seems like between schools being back in session in person and kids starting to get vaccinated, we're seeing this pick up a little bit faster in terms of the employment to population ratio. And again, this is prime working age. Still, we're still about 2.7 million workers below our pre-crisis peak, just like we were a couple of million short on the retiree age group, which kind of accounts for the fact that we're down about 4.8 million workers versus the pre-crisis peak. And this is just notes from the most recent employment that the number of people teleworking and being able to work from home is down from the prior month. A certain number of people couldn't work because their employer closed or they lost business due to the pandemic. This was 3.8 million, down from 5 million the prior month. The people that were unable to work because of closures or lost business was pretty much unchanged. And those not in the labor force and prevented from looking for work due to the pandemic was down about 300,000 people versus the prior month. So generally things are moving in a good direction on the labor side. And we're heading back to where if we kept going at the 500,000 added jobs this past month, we would be back to full employment or pre-pandemic employment within about 10 months. So what is that, the middle to end of next summer? Just in time to get there before the election. Job openings, and this is a combination of job openings, the number of unemployed, and the hires and quits. When we talk about the number of jobs added in a month, that's net jobs added. The actual number of jobs added, the gross jobs added and lost are multiples of that. And this is where we see this in terms of hires. I think we, ended up adding about 300,000 or 400,000 jobs in September, which is the month we're looking at here. The hires and quits are much higher because of velocity of turnover, whatever. And this is quits. Again, quits are very high. Total private 3.4%, total non-farm 3%. A lot of the quits on net, we're adding jobs, not losing jobs with people quitting. Therefore, most quits must be to take new jobs at higher wages. Plus, the size of the labor force is growing up 1.3 million since President Biden took office in January, as people, especially women, are entering the workforce. This compares to total 4-year labor force growth under Trump of only 545,000 net. Again, the economy is looking fairly decent under Biden, not a bad thing. We want to look at openings, hires, separations by type of work. We can have that information here, and I'll let you go through that at your leisure. If people don't have it, I'll put a link to this presentation in the chat. It was in the RSVP link, as well as what I emailed out. So hopefully you've got it, but if not, you can find it here. And there's a lot more transition the less education one has. The more education one has, the less likely people are to change employers, which isn't that surprising. And the people chasing the higher wages are the people that had less education or lower wage to begin with. So they're able to move around and get better jobs, and more of them are doing. Any questions about the labor market? Do we have a comparison of male versus female relative to job loss and the number returning to the workforce? I do not have that. When David starts presenting, I may see if I can pull that up. I used to be able to get it, but then they took away my ability to do Java searches on my browser, and so I don't have that ability anymore to get it to it as easily as I could 4 years ago. Mark's comment is that if you look at the recession recovery, we had a much faster recovery here. Part of it is probably where the funding was directed. The other part of it is how much funding we directed. A big problem we had in the Great Recession was that we started cutting the spending, not just on an inflation-adjusted basis or percentage of GDP, but in nominal dollars back in fiscal year 2010, long before we'd recovered all the lost jobs. We didn't end up recovering all the lost jobs until 2014.
Yeah, it was almost as if some people wanted the unemployment for political purposes.
The recovery this year and over the last year and a half have been much faster than prior recessions. and much faster than most economists predicted. And a lot of companies predicted, which is why they, didn't have the capacity or don't have the capacity to get back to their prior level of supplying goods. Federal budget. And what we have here are the last two Obama years. Now, again, fiscal years run from October 1st to September 30th. So fiscal year 2017 began on October 1st, 2016, when Obama was still president. It was his budget year, and he was president essentially for the first 4 months out of 12 of that budget year. So we had a slight uptick in the budget deficit that year. In actuality, we had, when he left office, we were predicting a $559 billion budget deficit. It ended up going up a little bit. And I'm not sure that we could really, point to things that Trump did in office that really raised that budget deficit. It was mostly shortfalls in revenue. So maybe you could point to the fact that he said he was going to cut tax rates and people deferred income and therefore taxes for a year. And that's what caused that to bump up from 559 billion to 665. But then under Trump, we started seeing regular increases in the budget deficit every year. Before COVID hit in fiscal year 2020, we were going to be over $1 trillion a year in both of these years. Now, when Trump left office, we were predicting a $2.3 trillion deficit in 2021. Obviously, the American Rescue Plan added a little over 400 billion to the last year's deficit. But again, this is considered a Trump budget year. And in actuality, the biggest pieces of that American Rescue Plan, like additional checks for every household, as well as extending unemployment benefits past March, were pretty much things that Trump would have been on board with had he continued in office. So what you see is budget deficits came down when Obama took office. In Bush's last budget, we were at 1.4 trillion, came down to 665, so cut in half, gone up significantly by the end of the Trump years. And now we're going to go on to what happens in the Biden years. What we see is that here's the last Trump year, which just happened, so it's no longer, well, this is still the forecast. It came in a little bit below this, about 2.8 trillion. But we're forecasting about a 1.2 trillion, maybe with the reconciliation and the infrastructure bill, 1.3 trillion. But the deficit is forecast to come down over 1.5 trillion in Biden's first budget year. So pretty significant. And spending is going to come down by probably over $1 trillion in Biden's first budget year, contrary to what a lot of the press thinks they understand. Again, fiscal years run from October to, we talked about who budgeted what years. The rescue plan numbers, the 1.9 trillion, are in these, the data here. The infrastructure plan and the reconciliation bill are not in these numbers. So that's why we've got the infrastructure bill is expected to add 250 billion to the deficit over a decade, or 25 billion a year. So it's not shown in these numbers, but it's not a major factor. The reconciliation bill, CBO is currently scoring, so we don't know what, if anything, it's going to add to the deficit. And as we see the numbers coming back up in the out years and getting back over $1 trillion after Biden's first term, this is not any legislative changes, it's the aging of the population. As our baby boomers, 10,000 a day retire or turn 65, that increases spending in Social Security, Medicare, And also Medicaid, which a lot of people don't necessarily understand, that the big increases in Medicaid spending we're seeing at the federal level are among senior citizens, because Medicaid will pay for nursing homes for people that have spent all their money and otherwise could not afford them. And that's what's driving senior citizen Medicaid in these numbers. So this is what we talked about, that even if the the deficits are going to fall under Biden, even if all of the spending in these bills added to the deficit, the annual deficits would still be falling, because we're seeing spending going from 6.8 trillion in Trump's last year to 5.5 trillion in Biden's first year. And we don't get back up there to that spending, even that spending level, until 2025, although we will with the infrastructure bill and the reconciliation bill, if they pass. I guess the infrastructure bill was signed yesterday. The reconciliation bill is still to be decided and passed. But the deficit surplus, it's going to 1.2 trillion this year, and then under $1 trillion for the next 3 years. So we'll see how that holds up. Look at things that Congress and the president have to deal with. Obviously, we've got the reconciliation bill that we're working on to get done this month. And as part of that, we want to go ahead and include some kind of increase or suspension of the debt ceiling, which got reinstated on August 1st, would have run into problems in, I think, September or early October, but we managed to get an agreement with Republicans that they pushed it out to early December, to both for the continuing resolutions and the debt limit increase. But McConnell says Republicans are not going to help with any further increase to the debt limit. They'd rather crash the economy if the Democrats can't do it on their own. And we wrote this early December, was less than 2 months away. It's now less than 1 month away. So we're getting close on both continuing resolution money, running out of money to fund the government from an authorization standpoint, as well as running up against the debt limit. Now, the debt limit, hopefully we can get a reconciliation bill that passes that takes care of the debt limit, and then we get some agreement on continuing resolutions going forward. And there's different relief programs that are going to expire if they don't get refunded. Real GDP, quarterly growth rates. After crashing last year, where we had a net real GDP growth in fiscal year or in calendar year 2020, I think minus 3.5%. We've had decent quarterly growth this year. Third quarter was lower. And lower than a lot of people were expecting. It's going to be revised twice. We note that the August-September job reports were both revised up substantially. So we'll see last week of November whether we start to see real GDP growth getting revised up as well. Now, fiscal year, the first quarter of 2021 is actually the last Trump quarter. So we count this 6.3% in with Trump, which gave him a 4-year average real GDP growth of 1.6%. The Biden quarters are the 6.7%, the 2%, which work out to an average quarterly growth rate of about 4.3%, which is better than any president since Lyndon Johnson back in the 60s. He was, I think, at 6.5. But the highest since Johnson was Clinton at 3.7. And then Reagan and Carter were both at 3.4%. So this is if it goes back up to something approaching these levels or even 4% growth, we're going to see Biden having better growth than any president since the 1960s. And the total level of GDP, while we haven't had full jobs recovery, we have had full GDP recovery. And so real GDP is higher than it was prior to the start of the recession. And we look at GDP recovering versus our pre-recession index, we see is that services, although they're recovering, are still down, but goods are much higher because people have gotten, comfortable with the idea of ordering stuff online and getting it delivered and filling up my building's dumpster with all kinds of cardboard boxes from Amazon and pet whatever. But people are still not comfortable going out back to in-person movie theaters and restaurants and health clubs and a lot of the other stuff inside, especially where people are not necessarily masking up. And so there's still a health risk associated with them. Whether it's people aren't comfortable or the businesses aren't comfortable, they don't have the employees. It doesn't take as many employees to ship goods as it does to provide services. Okay, and here we've got a shipping demand for goods causing port bottlenecks. TEUs are 20-foot equivalent units on tractor trailers. So we've had exceptionally high volumes and ports are backlogged, although processing is coming up. We're still seeing backlogs, even though we're processing more cargo through the ports than we ever have. We still, have backlogs because of the volume of goods we're trying to put through the ports. And there's issues at our end, and there's issue in China, as I mentioned earlier. Vietnam factories are just coming back online, and I'm sure that's true in a lot of Asia, where they're starting to get the vaccines so the employees can safely go back in the factories and work without spreading the disease. Because Vietnam, up until a few months ago, had almost nobody vaccinated. And that was true in July. My sister, who got vaccinated back home in San Francisco when she visited over the summer, was one of the first people coming from Vietnam to get vaccinated because you could not get vaccines in Vietnam at the time. And we see a balance of trade. We import more than we export, which has been true forever, if we can extend this back. And the trade gap has gotten a little wider. If we come back here pre-recession, we see we were probably about $80 billion more imports than exports. And now we're about 100 billion. So it's gone up, but not gone up by a lot. But we are importing and exporting more than we were prior to the downturn. Economic forecast from Wells Fargo. What we see is that actual numbers for domestic growth, 2.0% to 6.3, 6.7, 2.0, and expecting to bounce back up to healthy growth for the next 5 quarters. So we're expecting to see, we lost 3.4% in 2020. 2021, we're looking at 5.5%, 2022, 4.1%. So I expect that Biden's real GDP growth, as I said earlier, is going to continue to be above anything since the 60s, well through the midterm elections. Consumer price index, now Wells Fargo is pessimistic on this front because they're expecting an increased consumer price index for the next couple of quarters and to not really slow down much before the end of the year. So they're expecting 5.2% inflation on the consumer price index. Where I was looking at something from Goldman Sachs earlier today, that it was more like 4%. Again, even Wells Fargo is saying by 2023, we should be back down around in the twos. But, we'll see. A lot of it may have to do with the volatile food and energy. If gas prices come back down, if the Saudis decide to, provide a little more oil, inflation can come down substantially just because of fuel prices. Interest rates, they're expecting to hold constant through the middle of next year and then start to go up a little bit. Mortgage rates, you should have refinanced this year, but if you're going to do it now, because 3% mortgages are not going to last forever. Based on historical numbers, I mean, my dad was super happy in 67, he got a 6% mortgage. I was happy in 86, I got a 10% mortgage. So by comparison, these numbers are pretty darn good. So that's it for that economics portion. Does anybody have comments, questions that haven't been in the chats? Okay, I see another one. Okay, that the increase in the debt ceiling might last a little longer than early December or mid-December. That's quite possible. But we'll see. I will let David pick up what he does. Is now a good time to just do a quick break, David? Or I know we're not at the full hour, but this is a reasonable break. Or do you want to do one section and then do a break at that point?
No, it's a good thought. I think we can go till about 8. I think we'll be all right.
Okay.
And we can take a pause there. I think we can get through the inflation piece by then. One thing that Carl pointed out is that you have to understand how really amazing this growth is, right? Because Trump really badly wanted to get to a 3% growth rate, and he never got there. And let me start my video so you guys can see me. Hello. And let me share my screen. And there we go. Let me zoom down. You have, I'm going to hit a couple of the slides that we talked about here a second ago.
Okay.
Use that forecast. This one, for example, you have ports processing record volumes, but they can't keep up because this goods demand is so strong. So as much as we're hearing about inflation, and we're going to go through the inflation numbers in great detail and some of the explanations, it's because we have a boom. We have a very big boom going on right now in goods, such that ports that are processing record volumes can't even keep up. So when you're talking to people that are very pessimistic about the economy because of inflation and they're being fed a lot of negative inflation news, understand that this is one of the big causes, is that people are buying stuff like crazy and it's driving those prices up. And I'm going to go into some details on that in a little bit. But you also see here, imports normally are in this 210 billion range or so. Right now they're at 240. So they're about 10 or 15, $20 billion more, 15 or 20, 15-ish% higher than normal, just coming through, 10%, 10 to 12%, somewhere in there. That's a lot. That's a lot more stuff that's being imported than normal, even though the exports are kind of, they're not that far off from this sort of 140 billion-ish range. They're right in that range now. They've been up a little higher, but they're down a bit. But so you're seeing this enormous thirst for goods, and whether that's because people are not using services, obviously, whether it's people are a little depressed and they need more stuff to make them feel better. There's probably a series of things that are going on with people that have been cooped up for a long time and are buying in an amazing amount. So where Trump was saying, please, he's saying, I'm going to get to 3% growth, and was bragging about trying to get there. He never had a full year of 3% growth. He had some quarters. But here Biden is going to have we're going to see 3 years of it, 21, 22, and 23. So these are amazing numbers. And we're getting some inflation with it. I'm going to share with you in a little bit that Wages have actually grown faster than inflation when you compare against the pre-crisis level. So on average, people actually have more purchasing power than they did before the crisis. So I think while this level of inflation surprised me, it surprised a lot of economists in terms of how much we got. It isn't like stagflation like we had years, 30 or 40 years ago. This is a booming economy where everybody's demanding stuff and there's only so much of it. And so prices are going up. That's what you would expect to see with supply and demand, where the supply is just not keeping up with the demand.
I want to make a couple of comments there, David.
Yeah, go. Yeah.
Number one, Trump didn't promise 3%. He said Obama never got to 3%. He was going to for 4 to 6%, especially if he got his tax cuts back in 2017.
Yep.
That's the first point. Two,
good point. Yep.
When the Bureau of Economic Analysis went back and restated the GDP numbers a few years ago, maybe it was a year ago or so, Trump did have 1 year where he got to 3.0% real GDP growth, but at the same time, Obama had gotten a year where he was at 3.1% real GDP growth. But at the end of the day,
with the revisions, with revisions that he got there,
Obama had a year of over 3% growth. Trump had a year of over 3% growth. Although overall for Obama's 8 years, he was at 2.1% growth, and Trump for his 4 years was at 1.6% growth.
Oh, good color commentary. Thank you. Please keep it coming. This 3% threshold was sort of a magical thing that people kept talking about during the Trump era. And so as Carl pointed out, with revisions you got there, but look at these numbers, 5, 5, 4, 1, 3, 3. And remember, we're not recovering from a GDP perspective, meaning that we're already at a record level. We're not in here driving those kinds of growth numbers, which you would expect to see large growth coming out of a big trough like this. We're talking about already at a record level going into 2022, 2023 in the 4 and 3 range. And this year we recovered that GDP level. I think was it the second quarter or the first where we got back? Oops, sorry. I think it was somewhere in here. So it was the first quarter. I think it was the second quarter we got above.
Yes.
And then the third quarter, we're even further above. So we're already in record territory, still seeing spectacular growth numbers based on the last 20 years, 15 years.
The other point I'm going to make, all everyone talks about stagflation under Carter. Let's remember that real GDP growth under Carter, after adjusting for inflation, was just under 3.4%. Mm-hmm. Under Reagan, it was just over 3.4%. And other than going back to the 60s, the only president that beat those numbers was Clinton at 3.7%. So real GDP growth under Carter was dang good. And it was, the economy was not stagnant despite the great right-wing media myth.
Yes. And as usual, the right-wing media is very active and they're just hammering on inflation. You would think that the only statistic on this page is right here, Consumer Price Index. But we have a booming economy, particularly in terms of goods. There is about $4 trillion more in savings that people have than they had before the crisis. That is going to make this boom hang on. It's going to give it some legs to go for a long time, most likely. Despite the fact, as Carl pointed out, the budget deficit is going to get cut in half, which would be, remember, under Obama, that was a big crisis. Remember, you heard about all the fiscal cliff, and we can't let taxes, we can't let the budget deficit be cut so much by raising, getting rid of letting the Bush tax cuts expire. We can't have that. The right wing was on the opposite side, saying don't let the budget deficit fall so far. Well, I think Carl showed you this. That is a fiscal cliff. That is quite a fiscal cliff, and nobody's talking about it. Biden is quietly going to have the budget deficit cut in half, and nobody's saying anything because this is built into that Wells Fargo forecast. They're well aware of this, but this is a big cut in demand. This is a big cut in GDP. Other things equal. Okay, the government is going to be doing an awful lot less. That component of GDP the G component, the government spending, is going to be cut dramatically. And despite that, despite the huge cut in the deficit, you're seeing, sorry, I'm trying to go to the forecast. You're seeing these kind of numbers, despite the budget deficit being cut in half. Now imagine if that budget deficit were going up or staying the same, these numbers would be even bigger. So that's despite austerity. We've got massive growth coming up. So keep that in mind as you're talking to people. Inflation is the right wing excuse to distract you from this, a booming economy, really booming. And we haven't seen its like in a long time. So let's look at this. Let's go into the inflation now. And I think because we've been talking here, no, we got a little time. We'll go through a few of these, then we'll take a break around 8. So Carl, I'll ask you to be my conscience and stop me around 8-ish when we get to a slide end here. So let's just go through the inflation numbers. This is the monthly change. So this is each measurement on this page. Each bar is a comparison against the prior month. So we had a big one here in terms of a almost 1% increase in inflation in just 1 month. So if you multiplied that by 12, you'd have 10, 12% inflation in a year. That's a very high number. Wasn't always like that. These last couple of months were much lower than that. And then as you go back into 2020, the later part of 2020, these numbers were very minor. So we're definitely seeing an increase in inflation, no doubt, and it had been sort of petering out, and it had been slowing. That rate of growth had been slowing, and then it jumped back up again, kind of like we had here in June and April. So it's more widely based than we've been seeing in the past. Like in the past, it was a couple of areas, but now it's really starting to be wider. It's affecting more kinds of things. We'll look at that in a little bit. This line is the percent change from a year earlier. So not the prior month, but the prior year. So in October 2021, prices were 6.2% higher than they were in October of 2020. And 4.6% for what's called core inflation, or if you take out the food and energy, which tend to be more volatile, the numbers are going to be a little bit lower, 4.6. Now, bear in mind that in 2020, we had very little inflation, 1%-ish, a little bit more. So you've got almost like 2 years of inflation happening here. If you add 1% to each of these numbers and divide by 2, that's about what your 2-year inflation rate is. So 3-ish, a little bit higher. 3.5%. You add 1.25 to this or so, 7.5 divided by 2, 3.6, 3.7. You're seeing that's the kind of inflation on average over 2 years, which isn't quite so scary as 6. It's just we had no inflation in 2020, very little, and now we're making up for it as the economy is starting to boom again. This column has those numbers from the prior page that are the comparison against a year earlier. These other ones over here are versus the prior month, so that's where you see the 0.9-ish. And there's some drama with the seasonally adjusted, unseasonally adjusted. These happen to be the seasonally adjusted numbers, so you get a sense of where they are. Gas, way up. Food, used cars and trucks. Before, it was more like the cars and trucks and the gas were crazy, but food and apparel weren't really an issue. Those have been coming up lately. They've been moving up. And the medical services had been very low and it's been coming up a bit. We used to see this all the time at twice that, but medical services demand has been down during the crisis. People not going to the doctor as much, and those prices have not increased as much. Let's take a look at some of these sectors. Let's go into some individual items that are kind of things that people buy kind of stuff. We're not all buying fuel oil, but as you get down into here, beef, 20%, bacon, 15%, furniture, 13%, eggs, 12%, TVs up, which is rare because it used to be electronics kept falling in price. They are going up. Trucks, new cars and trucks, dresses, and on down. And then here we have some negatives. Smartphones, surprisingly, good time to buy a smartphone, I guess, 21% down. And this is the annual price change. This is versus the prior year. So this, it's not the prior month, but a year earlier. So we're starting to see some stuff that hits the kitchen table that is having a significant price increase versus the prior year. One thing about this is that this is really driven by goods, not services. And Carol and I shared earlier how it's the goods that are very much booming. The services are still a little bit below their pre-crisis level, but the goods are like 10% above it. And so you see here where the inflation is coming from. And this is a fancy way of saying the inflation rate. The personal consumption expenditures, implicit price deflator is really just it's an inflation rate. Okay, don't get hung up on what that means. There's a definition down here if you're curious, but for the normal person, it's an inflation rate. And you see it, this blue line is the goods, 7%, and you see here for the services about 3.5%, and the services are up a little bit, but they've been, fairly flat. But look at this guy, just after going down for a few years, the goods getting cheaper like electronics. Now that's reversed because people are buying this stuff like crazy. And so Paul Krugman shared this slide and explained that the inflation is being driven by goods, which is not surprising because that's where the demand is, as we've shared with you. So keep that boom in mind. One of the things the Fed watches, take a look here, got a couple minutes. One of the things the Fed watches, they talk about it in Fed speak, but they say, watch out for inflation expectations. Our expectations anchored is the term they use. And they don't want to see this number start to go 5, 6, 7, 8%. This is the convention. This is the wisdom of all the investors buying Treasury securities, saying we expect inflation to be about 2.7 over a decade, on average. A little bit higher now, lower later, and you saw the forecast. Carl covered it. How Wells Fargo expects that inflation to be lower a couple of years down the road from now. So this is the difference between two types of securities they're identical except for one thing, and that the blue line is inflation protected, meaning the value of the security is adjusted, kind of like a cost of living adjustment for Social Security. The security itself is adjusted based on the inflation, based on an inflation rate. And so that's why there's this difference. The investors, they know they're going to get that, and so they are willing to take a lower return on it because they're going to get a boost for inflation. That's where this is the unprotected security at 1.5, just the basic Treasury security. So you can look at the difference to see what do investors really expect inflation to be. It's a really, I think, a brilliant way of thinking about inflation. I did not invent it. It is how, when they talk about investor expectations for inflation, this is the kind of analysis they're doing. And there are a variety of securities in the business that they compare to see this sort of thing of, you take a security that's the same and you change one thing and see what that implication is on investor perception. But the Fed is worried about this number starting to expand like crazy, and it's been expanding a little bit lately. So they're going to be watching this, but so far they're not panicking about this. And you saw the Wells Fargo expectation. One other thing that's going to be interesting about inflation is, remember, we're comparing the 2021 prices against the higher 2021 prices against lower, unusually low 2020 prices. That's called a base. They call it a base effect. There's low price against the high price. Next year, though, we'll be comparing 2022 prices against the elevated 21 prices. And so it's going to be interesting to see if the inflation rate really continues, and we could possibly have even deflation 2023, probably, when we're comparing against elevated 2022-ish numbers. So curious to see how that happens here. All right, so let's pause there for a break. We'll talk a little bit more about inflation when we get back. We'll talk about what's going on globally, which is that it is not just a U.S. phenomenon. We are starting to see inflation all over the world. So as much fun as it is to pick on Biden for inflation as if he caused it, the rest of the world is seeing it too, not always to the extent that we are, because our government stimulus was massive. Our people have a lot more savings that they've saved up, and they're using that to buy stuff. So let's return at 8:05 or so, and we'll take a look at the questions that have come through, if any, and we'll take a look at those when we get back. Thank you. Can you guys see this? Can you hear me?
Yes.
All right, let me put it in presentation mode. We will get back to it, because you can never have enough on inflation, right?
Well,
All right,
hopefully by next year at this time, or a couple months before this time next year, inflation will have subsided enough that it won't be a big factor in the midterms.
Yeah, this is a good challenge for Democratic messaging because the Republicans only have really one attack line against a booming economy like this, and it's inflation. And Joe Manchin didn't help the thing by saying, we can't have the big, we can't have as big a reconciliation bill because we've got inflation, blah, blah, blah. And so we have, it's the latest conservative boogeyman to prevent the Democrats from doing good things for people. Under Obama, it was the deficit, and then now it's inflation. And we have to get in front of that messaging and really be aggressive about the kinds of messages you're hearing from us tonight, which is we have inflation because we have a massive goods boom. And it isn't because the supply chain is damaged. It's processing record volumes. It isn't because Biden made bad policy choices. He's doing the right things. It is a function of consumers with an incredible amount of money. And it'll be interesting when Christine does her MMT presentation to see, if we get into the discussion of, are we seeing MMT in practice where you put an incredible amount of stimulus through, you have some supply constraints, so you see inflation, which is exactly what MMT would say you would get. And the solution from the MMT stuff that I've read is, when that happens, is you want to cut the budget deficit. And that's what Biden is doing. The budget deficit is going to be cut in half. Usually the tool that MMTers would say is you raise taxes. Biden isn't planning to do it that way. It's simply we're going to be cutting the spending enormously to cut the budget deficit. So we'll see how that works out. But this is kind of an interesting case study in applied MMT is can you get the U.S. economy to inflate a little bit if you put $6 trillion in deficits into it over 2 years, as Carl pointed out? Maybe. If you have supply constraints because of a pandemic, yeah, you might. So, here we are.
Well, to talk about that a little bit more, okay,
Sure.
The fundamental difference is when the bank dumped $30 trillion into the world economy, okay, where did inflation go? It didn't, right? Now, when our government put $1 trillion into the pockets of human beings, okay, suddenly not spending it on services, but spent it on goods, yes, suddenly we have inflation because we hit the limits of the capacity of the world at this moment.
That's right. And, I one of the guys I follow on Twitter is a finance commentator was like, you're not hearing anything from the MMT people right now because there's inflation. It's like, well, that's exactly what MMT predicted. And the solution would be, and we'll talk about solutions for inflation in a little bit. One of the MMT solutions would be cut the budget deficit, meaning usually by raising taxes is the policy choice. But there are other options, and we'll be hearing more about it. But please, anybody on this call, this isn't like we've got 500 people on the call. I think, feel free to comment, ask questions as we go. I mentioned a little before the break. So it's not just in the U.S. where we have inflation. The Euro area is also seeing it. And some of these numbers are slightly different from what we've shared earlier, just because of the way that some of these things are. Actually, I'll show you that in a minute. These numbers are the ones that we've showed you earlier. The Euro area is at about 3 and 4, but it's a month back. It's September. So if they get a spike like we just saw in the last month, they're not going to be all that far behind us. So just remember, that's why I drew this vertical line. Now that I remember, they're a month back. So they're probably going to be up here somewhere after they have their next month's data. Now here's where the numbers are a little bit, I believe, a little bit different how they do them. And they've got them, there's in the small print down here, they're explaining the different estimates of how they're doing the inflation, because not every country measures it the same way. So they're trying to harmonize that as best they can. But these are the G10 economies, these are big or European economies. And it's not just here. You're seeing this inflation across the different countries. I think Japan and Norway being the exception. Everybody else, the dark blue line is much higher than the light blue line. So inflation's picking up. What was inflation in November 2020 versus the prior year? What is it now in November 2021 versus the prior year? Actually, that would be September, I guess, would be their number. It's interesting. They got a November here, but then they've got a number there. We don't have the November numbers yet, of course. So this is a Goldman Sachs chart from an interesting study they did. If you can always check, the big banks have different things they put out for their clients. Some of it's free, and Goldman Sachs does that. And then Wells Fargo, we talked about earlier, they have a website, Wells Fargo Economics, which is a ton of free stuff that you can study on almost any topic you can imagine is out there for the public. But so it's global. It's not just the U.S. Now, one of the things that, as much as we hear about the inflation side, so the price side, well, what's going on with wages? This red line is real wages, meaning adjusted for inflation. And this number, the latest, 2626, that is the wage for the hourly production and unsupervised employees. This is a good measurement of typical workers. The management workers are not considered the production and non-supervised. They would be supervisory employees, which tend to skew this number up because makes it a larger number because they are higher paid. This is your typical middle class wage earner or working class, those two groups in here. And so when the crisis hit, prices spiked because what happened is this is an average calculation, and a lot of lower wage people actually came out of the pool because remember, the crisis hit those lower wage people disproportionately hard. So restaurants, bars, gyms, lower skilled people, those services shut down and they were out of a job. And so this number spiked suddenly, and now it's been coming down. So when I see, I think it was in the New York Times of all places, or maybe it was Washington Post yesterday, had an article that was like, the real wages are down, real wages are down from where they were a year ago. And it's like, well, yeah. I mean, look what happened. So we were in here. So, but when you look at pre-crisis, before this weird sort of statistical aberration here of all these people being removed from the pool, now they're coming back. We're not that far down below the number of jobs. This number has been trending down a little bit, but it's been pretty stable through here since this initial jump at the beginning of the crisis. We're still up, meaning that on average, the wage earners' purchasing power is higher than it was before the crisis. So as bad as inflation's been, the wages have grown faster since the beginning of the crisis, and I'll show you that in a second. That's how the real wages are higher than the crisis. The reason the real wages are higher now than they were back here in February of 20 is because the wages have grown faster than inflation. And that's the blue line is the nominal wages, it's the raw dollar number, and then this is the adjusted number for inflation. So purchasing power is up. That's a good thing. And here's where you can see the wages and the inflation. Since February of 2020, inflation is up 6.9%. Hourly wages are up 9.6%. And notice that there was that initial spike, and then it's come down. But even then, the hourly wages have really gone up a lot. And that's a good thing. So as much noise as we're hearing, oh my God, look at the 6.9. Yeah, oh my God, look at the 9.6. When you hear people, give it back to them. And there's a lot of propaganda out there, a lot of just constant messaging negatively about inflation. It's like, well, wages are up, people. And part of the reason why we're getting this is these factors, these go together. And when wages are jumping, people are buying more stuff with that money. And that brings the inflation rate up. Prices go up too.
Yeah.
So, but
overall
really,
wages are up.
Yeah,
I would point out that not everybody is getting those increases. And so for some people, wages are down, real wages are down. They're not keeping up with inflation. A lot of people have to change jobs to get to those increasing real hourly wages to beat inflation. And that takes a bit of gumption to go ahead and make that change. We are seeing it. We had record numbers of job quits the last couple of months, but not everybody's quitting their job. They've been there a while. They have a certain amount of comfort, even if they're falling behind a little bit every month. And so they're, not everyone is seeing these kinds of results, but overall, people are.
And it's important. I've heard it in Biden's messaging. He says wages are up, but he doesn't say wages are up quite this way. He doesn't say wages are growing faster than inflation, your purchasing power is up. He's sort of taking the more sympathetic view.
Yeah.
He sort of says, we feel your pain, but guess what? Wages are up. It's sort of on the side. He's not really hitting the message, and I think he could a little bit more. So what can you do about inflation? That's one of the big questions right now is what should or could Biden do? And it's been a long time since we really had inflation to worry about. So it's sort of, I know I was a little rusty on thinking about this, and then so are probably some economists out there. But this is couple of interesting ideas for you. And first of all, I think everybody has a sense of what inflation is. Too many dollars chasing too few goods, demand greater than supply. And this is what we've been talking about, this large increase in demand for goods and some supply disruptions due to the virus. You've got prices going up. And whenever you hear about supply side economics, sometimes liberals will say, that supply side economics is a bad thing. Supply side economics is another term that Republicans stole because they use it for tax cuts. Conservatives stole it. They use it for, supply side economics means tax cuts. And that's not really what supply side economics means. Supply side economics means things you do to enable your economy to supply more stuff, which in theory, if demand were constant and supply were expanding, prices would fall. You want to expand the supply capacity of and there's two sort of ways you do it. You can expand labor and you can expand capital or technology. And if you invest in infrastructure like Biden's doing, that's a big way to expand supply. The ports can process more stuff. The airports are also, there's a ton of air shipment going on, waterways. We're having trouble with ships and processing them. Getting the infrastructure built is one way to do it. You can also get better, you can get more productive. You can invest in technology to automate your ports or build better systems. You have incentives for more production of goods in short supply. Like what can the government do to subsidize loans for a company to build a giant chip factory here? Or create a company that can build a ton of containers because there's a big container shortage right now. What can they do to essentially subsidize those things? Now, switching over, that's more on the capital side. On the immigration side, you can expand the labor supply. And this is a political hot button, obviously, and not just on the Republican side. There are a lot of Democrats that are leery of allowing lots of immigrants into the country, unfortunately. And now, when you've got 10 million job openings, is a great time to let a lot more immigrants in and put them to work. And that's a big part of expanding the labor supply, is getting more people. Other ways of doing that are programs that allow people to have better childcare so that they don't stay on the sideline. They have more affordable childcare so they can enter the workforce. It's things that get people into the workforce. And then eliminating the Trump tariffs is another one, because that just raised the costs of this. The Congressional Budget Office did a study last year and said the average American family paid about $1,300 more in 2020 because of the Trump tariffs. The top secret report, I'm kidding, but it's like nobody talked about it. But the Trump tariffs were paid by Americans, and they were paid to the tune of about $1,300 a year. And so we can get rid of those, and that can help also address some of these issues to encourage, again, more generation of those goods, because if you make those goods more expensive, you get less of them. So you want to get rid of the tariff and find other ways to raise revenue if that's your goal, or if Trump was trying to punish China, there may be other ways we can choose to do that other than tariffs. So that's on the supply side economics. I just remember supply side economics is what Republicans stole that term and made it about tax cuts. It's not. Expanding supply is a very valid strategy. Just like we always think of Keynesians as expanding demand, do a government stimulus. Expanding supply, also very important. Biden is on the case with the trillion infrastructure law, which we'll get into on that one when we get into that section about him. And then the other one is while right now we've got a little bit of excess demand in the system, maybe we take some of that back. We reduce the budget deficit. You can raise taxes, but also obviously we were doing these trillions of dollars of stimulus programs the last couple of years. We're not going to do that anymore. That will take demand. That will take the air out of the balloon, so to speak. We're going to be lowering demand. And then also, obviously, the vaccinations. Getting people more comfortable spending on services and less on goods. So we have kind of, in businesses, we call it a mix issue. If you have a mix of products, you've got a mixed problem. You've got too much of this and not enough of that. And we have a mix issue in the economy. We have a service goods, too much demand in services. We need more in goods. I'm sorry. We have, too much on goods, not enough on services. We want people to spend more on services, less on goods. I can read my own writing here and make it easier. So let's do that. And that also kind of is a supply side thing as well, because we did as well as Canada, 500,000 people that died would be with us if we had done as well as Canada on the coronavirus. So, there's just this dealing with the virus still is that key thing, and the Federal Reserve keeps pointing that out. The key to getting the economy healthy is getting everybody vaccinated, and it also applies to inflation. So any questions on that? I'm seeing a lot of stuff in the chat, which is good. Let's cover some of that stuff.
The two things we didn't cover, and I don't know whether we can cover what % of our exports are weapons related. I think it's a fairly small amount, but I don't know that answer. And the other one right below that is Lori's comment about why do we call it the reconciliation bill? Does that mean something? Does it really mean anything to the average person?
Yep, no, that's a really good one. You want to start with that one, Carl? I'll throw in the commentary.
We've had a lot of names for this bill as it's been developed over the last 9 months. Currently, I think we've settled on Build Back Better. And so we should be using that branding currently. But I think people call it the reconciliation bill because that's the process. And it's also to remind some people that you can only put certain kinds of things in a reconciliation bill. We can't put voting rights in a reconciliation. I mean, I think that's one reason why, especially since what we were calling it kept changing it, I think I developed, a habit of just calling it the reconciliation bill because I wasn't sure what we were calling it this week.
Yeah, I mean, Biden, when he came into office, Biden had two, I'm going to say maybe more than two, but he had, I guess it was sort of three pillars. There was the American Rescue Plan, which was what to do about the virus, and he passed that. That's the 1.9 trillion. That's the checks and the $1,400 checks and the checks every month for the child tax credit and some other things too we've covered in prior meetings. That was number one. Number two was the American Jobs sort of plan, which was this infrastructure bill and some things that are now going to be in the reconciliation bill. And the third part was the American Families Plan, which was the expansion of the safety net. He organized his thoughts in those three lines. So we got the first one checked off. We got a lot of the second one checked off now with infrastructure. And now we're going into the third one, which is the American Families Plan, which is this now in this reconciliation bill, which is where he's trying to get all that passed. And as I'm sure everybody in this call knows, but I'll say it in case a wider audience sees this on YouTube, is that reconciliation, again, is where the Democrats can pass stuff with 50 votes in the Senate, with the tiebreaker being the vice president, because the Republicans will vote against it. And, this, you don't need, it's not subject to filibuster is the key thing. So you don't need 2/3 of the senators. It's 2/3 or is it 60?
60 votes.
Senate votes? 60 votes. You don't need 60
61 votes to break the filibuster.
We can do it. We can pass reconciliation without it. Like Carl said, they have to be budget related things for the most part. I'm simplifying because I don't know it in much more depth than that, to be honest. You have to pass budget type things. So voting rights are not going to be in there. If we want to get voting rights passed, we really have to convince Manchin and a couple others to make a filibuster exception so that Democrats could pass it with a simple majority in the Senate. And that hasn't happened yet. He doesn't want to do that. So at least so far. So reconciliation means to a regular person is how you get stuff done. If you're a Democrat, you need to do it with 50 votes. And they're working on it. And we should know what that is soon. Carl mentioned earlier, we're going to get a CBO scoring of the bill by Friday, I believe it is their latest guidance. So we should, is it?
I haven't seen anything's definitive date. I looked for that and saw something that came out last week that said they were going to start releasing pieces of it as they became available. But I don't think the CBO is committing to any particular calendar just because, they weren't sure how long it was going to take.
Right. No, good point. I mean, I suspect that legislation is moving around. So we're going to have, it'll be interesting next month to go through that. Hopefully the law will be passed and we'll be able to analyze it in detail. We'll talk a little bit about it in a bit here when we get into the Biden plans. So I'll hold off on any further, but we'll get into this. We'll talk a little further about the reconciliation bill here in a minute. So I'm not going to read all this as much as that breaks your heart. This is Fed speak from their last statement on November 4th. Very positive in most cases, and they've thought enough. And this is another way of seeing it, how the Fed perceives the economy, not only what they say, but also the actions they're taking. And this green piece down here, top of the last paragraph, in light of the substantial further progress the economy has made toward the committee's goals, committee being the Fed, the committee began reducing the monthly pace of its net asset purchases. So the Fed is taking its foot a little bit off the accelerator. It's not tapping the brake. It's slowly saying we're going to buy a little bit less of these bonds, and that's a stimulant. When they buy those bonds, it's stimulating. So when they are buying a little bit less of the bonds, they're taking their foot off that stimulus gas, so to speak. So they are, and they're going to actually, if they stay on their schedule, will end it, and then down the road, somewhere in 2022, middle of there, they may actually raise the interest rate a tiny bit. But before they do that, they're going to be warning people for a while. And this sentence here in red, the path of the economy continues to depend on the course of the virus. That's the bottom line. If you are able to get services booming again, then that'll take a lot of pressure off goods because people will spend over there, not on the goods. That'll start easing that inflation a little bit. And hopefully that will happen. It'll be interesting to see the next GDP report to see how services how they're recovering. So there's a lot of, believe it or not, there's a lot of information, good information in here. The Fed agonizes over every word, and so does the media. So there's a concise analysis of the economy and what they're thinking about at the top of the pyramid, so to speak, in terms of that they have the best access to economic data of anybody, and this is what they have to say about it. So take a look. Piece of good news for Biden, which he did not talk about very much because it has sort of that stigma of applying mainly to rich people. He set the stock, Biden has the record now for the fastest increase in the S&P 500 in the first year of the presidency, measured from election day. So measured from election, Biden's up 37.4, Trump up 21.3. And this number is about 22% from inauguration, which would not be November 10th. Sorry, whoops. Yeah, no, inauguration would be January. Sorry about that, but I had the November 10th was the 1 year compare. That actually should be, this November 10th should be up here. But the from inauguration in January is up 22%. About half of Americans own stock directly or indirectly through the 401k. So a lot of Americans, and if you have a S&P 500 index fund, which is a very popular investment to have, that chunk of money is up 37%. That's a very good thing. However, the stock market is very skewed to the rich. The top 10% own about 90% of the stock. So that's why I think Democrats don't always brag about this as much as they should, but they probably ought to anyway. Because half of Americans, a lot of Americans who vote, would love to be reminded that, hey, your portfolio's up and, hey, I'm president. Trump would not hesitate, as you know. He was always about marketing. That was one of his gifts, and he was good at it, sadly. And here's where Biden could be tooting his own horn. He now has the record. All right. Now, going from a fun topic to a somewhat drier topic, as you might think it's a somewhat drier topic, but it is surprisingly important because of the amount of it, is tax expenditures. You're going to say, what the heck is a tax expenditure, Dave? Well, let's talk about that. And it's a big number, lots of big numbers. So a tax expenditure are deductions, exclusions, preferential rates, things that reduce the tax liability versus paying the rate table amount. It will not surprise you to hear that the benefits are very skewed to the rich, which I'm going to share. But look at the amounts. These are in 1 year, $1 trillion, just this bucket. And then this bucket, the payroll tax bucket, 200 billion more. That's in 1 year. Because we always hear budget math is 10 years, right? If you were to eliminate all these exclusions, deductions, preferential rates, and just make people pay the rate table, you would get, it wouldn't be all this money because people are clever about evading taxes, but you'd get, let's say, 2/3 of this, 3/4 of this. You can get rid of your deficit problems. You don't even have to raise the tax rates. You just take away all these loopholes. And let's talk about what some of the big ones are. When you work for an employer, if you have an employer and they're covering your health insurance, you're paying a certain amount, the employer's paying a certain amount. You don't have to recognize the employer's portion as income. Even though they're paying those premiums on your behalf, it's not income. The next one is the 401k. So that's an exclusion. Next one is the 401k, also excluded from your income. That amount that you're putting in your 401k, some people have pensions like IRAs and other accounts that are tax deferred. The government estimates that if they tax that stuff like income, it would be $200 billion a year. So people are able to exclude that from their incomes. And these two affect both the income tax side and the payroll tax side. The other ones do not affect the payroll tax side. This is the big one that the rich really get the lion's share of, and I'll show you that who gets what of these in a second. Capital gains and dividends, a lower 20% tax rate for capital gains rather than just applying the rate table, $140 billion a year. And just for scale, our budget deficit pre-crisis was about 4% of GDP, somewhere in there. So when you see 1.3% of GDP, just with one line item on here, it gives you a sense of how much money we're talking about. You can see it here too in billions. Think of $1 trillion budget deficit as about $1 trillion a year. That's almost the same number here. I'm not going to go through every one of these. I think you're familiar with some of them. I actually can't define every one of them, but this is where the big money is. And some of the ones down here that hit home are the mortgage interest deduction and the state and local tax deduction. A progressive would say, get rid of these for the rich. You can leave the rest of the people, let them keep them, but the rest of the people, the rich people, take it away. You can take away a lot here in the capital gains and dividends and not even do anything else and still make a big dent in the deficit. This gives you a sense of how big they are. This is the outlays of the government, mandatory, discretionary, and net interest. You have to add these up. This mandatory is like Social Security, Medicare, discretionary is defense, and all the other departments like education and others. And then net interest here. If you stack these up, you get to that. Last year was a lot, but 21, 22% of GDP is a sort of pre-crisis typical amount. And then here's revenues. You would stack these. And then here is the tax expenditures, which are almost equal to the amount we collect in individual income taxes. It's a very big chunk of change. Here is who gets the benefit. And here's the summary, the headline up here. Top 20% of income earners get about 50% of the benefit. So about $500 billion. And this is just of that income tax amount. So this is, go back a slide, this $1 trillion income tax expenditure. Also this $1 trillion here. And it's over here. Who gets it? Top 1% gets somewhere around 20% of the benefit. Top 20% gets 50% of the benefit. Top 1% gets 20% of the benefit approximately. And these are the amounts, 500 billion, 180. So you could take away the tax expenditures from the top 20%, and it's about 500 billion, or you could take it away from the top 1% and get about 180 billion. So we have our quiz question. See if you guys are still awake. Given those two pieces of information, what share in dollar amount is the 80th to 99th group getting? So who's got their calculator and can give me that answer? You have all the information you need on that page right there. I'm going to look at the chat while you guys are chewing on this. Anybody? Nobody wants to answer the question? So if the top 1% is getting 180 billion, and the top 20, which includes the top 1%, is getting 500, then that next, the top one's got 180, the next 19%'s got the difference, which is 320. But as you can see how it's distributed here, I'm going to show you the distribution now for each line item. So these are percentages, like here's the preferential tax rates on the capital gains and dividends. Top 20% get 95% of that. The top 1% gets 75% of it. Remember, the top 1% owns about 90% of the stock, and that's why. So you can get rid of this, barely touch the bottom, the bottom 90%, 80% barely get any of this, and get a big chunk of change coming in to address the budget deficit. The mortgage interest deduction, the SALT, you hear Democrats talking about every now and then, that's down here. But you can get a sense of the percentage of each of these, and you can think about, if you were king, which ones would you eliminate? I'd start with the capital gains and dividends for the 1%. I would take this chunk out right here, 75% of 140 billion. Let's put 100 billion back in the kitty without affecting the bottom 99% directly. So this is just the Cbo summary, and has more if you're like your head is spinning because you've never heard of tax expenditures, you're not used to dealing with the math. There's sort of their summary at the beginning of it, and it had been about 6 years since the Cbo updated this report, and they just did it last couple weeks ago. So that's why it's got great information about one of the best ways to address the budget deficit without affecting a lot of people in a very simple way is simply to just pay the rate table, just get rid of all this stuff. And, if you need to, you can always give people at the bottom, they get a credit or something else so that what little bit of this that hits them or the benefit they're getting, they just get offset. There's a lot of ways you can handle getting rid of these tax expenditures for some or all groups. All right, let's pause and take a look at some of our chat stuff here. Maybe Biden should show a few charts. Amen. I'll show you one of his, but he needs to show a lot more. I would love it if his next State of the Union were a PowerPoint, but I don't think I'll live to see that. I think a few years ago, Obama did it that way. I don't think he shared them in the Congress, but he had a matching slideshow that went with the State of the Union. I don't know if we do that every year, but he did that, and it was a great presentation. And I hope that Biden does something like that. We've got some questions about gas or comment about gas from Carl. Yeah, $3.38 to $4-ish for gas. Yeah.
On the 389 was the cheapest gas in my neighborhood. I can easily pay over $4 a gallon.
Oh, okay. Yeah. Yeah, it's like $3.60 out here in the burbs.
Yeah.
50.
Went to a music show down at a little theater in Lockport on Saturday night. Met some old high school friends and had dinner, and on the way back, a lot cheaper gas.
Any questions on tax expenditures before we go on to Biden's plans? So the infrastructure plan, and some of the charts I've got in here are duplicative, just so you can some of these are for, I'll share you'll see it in different ways, so you can think about which way is intuitive for you. But one of the things about the Infrastructure Investment and Jobs Act, which just passed, was just signed into law. Was it last night or 2 nights ago? When was it? It was very recent, like just the other day. The math is kind of weird. They call it the $1 trillion plan. It's $550 billion in new spending above what Congress was already planning to allocate over 8 years. But then CBO said they only think it's going to add about $256 billion to the deficits. And the reason that is total. So you're like, well, why not $1 trillion? If the Congress is spending $1 trillion, why isn't adding $1 trillion to deficit? The reason is it's not truly $1 trillion above what we were already spending. We were spending $70 or $80 billion a year in infrastructure already. So I joke and I call it the $256 billion stimulus plan. It is nowhere near as big a thing. Trillion is a nice headline, good marketing on the Democrat side in terms of impact, but the CBO said, listen, we're already spending $75 billion on average a year. We're going to call that the baseline. If you want to spend $1 trillion, great. We'll say it's going to hit the deficit by $256 billion. And this $550 billion in new spending, I think, was above what was already sort of legislated or set up over 8 years. And that's what's shown in the graph. But again, that overlaps with kind of the CBO saying, well, some of that obviously was already kind of built into their baseline. So you hear these three numbers, that's 250, the 550, the trillion, that's what they're about. And also why I think progressives were a little disappointed in the infrastructure bill saying, hey, we're happy to help, but it's 256 billion people. You're already getting 800-ish over 10 years. It isn't something that's transformative. So Biden's selling it right now. but it isn't a ton of money above what CBO thought they would have spent anyway, and had been spending historically. So these are the buckets where it's going. Roads and bridges, power infrastructure, passenger and freight rail, broadband, and on down the line. Again, much of that would have been spent already, but there's some incremental $250 billion, $25 billion a year. And that's what we've got. So it passed the House. 13 Republicans joined 215 Democrats. And there were a few Democrats that voted against. Were there a few Democrats that voted against it in the House, or were we unanimous in the House?
Half dozen or so voted against.
Yeah, there were a few. Okay. So bipartisan, which we like, and that's a good thing. So here's another. This is just as part of, okay, now this is Biden's framework now. So I'm switching gears. This is more about the family's plan, or this is more along the lines of the reconciliation bill that Biden laid out there that he wanted. Now, where this ends up in the CBO scoring, I'm curious to see, because there's been a lot of stuff going in and out of the bill, and we'll see how much of it survives and what the duration of it is, meaning some things may get in there, but they may only be a year when we had planned to do 10 or permanent. So this is kind of what's in there, a lot on climate, universal pre-K, extending that tax credit for parents, the child tax credit, which is those $250 to $300 checks every month per kid. That wasn't zero before. It was a fraction of that, but it's higher than it would have been otherwise, and paid in advance. Used to have to wait till you filed your tax returns, is my understanding. Now they're paying you a check, putting some money in your account every month. And so some other things here. If you're a family that's waiting for in-home care for seniors and disabled Americans, that's quite a nice perk to keep your family members at home, rather than put them in an institution where they hate to be and where you don't get to see them. It's nicer if you can care for them in their home or in yours if you can get it paid for. So there's a lot of good stuff here. This is another way of looking at it. This was a chart that Steve Ratner shared. This guy is somebody I would recommend you follow. He's on he does the Morning Joe charts. He was an Obama guy, fairly centrist Democrat. He's not a liberal, a progressive by any stretch, but he shares some pretty good charts and explains kind of what's in this thing. The same chart as almost the same chart as the prior page, just in graphic form. Now, that was the spending side. Let's look at the revenue side. Biden does plan to offset that fully. He said over and over and over again, I'm planning to pay for my plan. It's not going to add to the deficit. Probably will end up adding to the deficit, but we're going to see what CBO says. But a minimum tax on corporations, so that you hear the stories of corporations that are very profitable from an accounting standpoint, but don't pay any taxes because if you know corporations, they keep a set of books for their financials. They keep a set of books for tax purposes. That's all legal, nothing illegal about it. It's just that's how they do it. And this thing says, if you're going to report profits from an accounting perspective, it's going to override whatever your tax books are saying. That minimum is just going to have to be paid. I think it's a brilliant idea to avoid any kind of tax avoidance strategy that companies have. If a company says, because the companies they have a very high incentive to continuously increase their profit from a stock market standpoint and report that to Wall Street, government saying, great, knock those profits out of the park. You're just going to have to give us 15%. So it's a really good idea. And there's a few other things there. I love the 1% tax on stock buybacks. And you get stock buybacks are a way of basically a tax avoidance strategy. If you pay dividends to your shareholders are going to pay taxes. They're going to treat that as ordinary income for the most part, and they're going to pay taxes on. But if you do share buybacks, you jack up the price of the shares, but there's no taxable event. As long as you don't sell the shares, your shares just keep appreciating. So it was mainly a way to avoid taxes, and it worked brilliantly. There is $1 trillion a year or so. I haven't looked at the numbers lately, but about $1 trillion a year in stock buybacks. And if the government gets 1% of that, great. Let's take it. I'd like it to be higher. But that's one way of doing it. It's really just it's a stock. It's a way that the rich get richer, is that 10% that owns 90% of the stock just loves the buyback thing. Makes them richer, and they don't have to pay taxes. It's a win-win. What else do we have in here? Well, some of those others are more complicated. I'm not sure exactly how they work. Well, I guess the second to last one, tax on incomes exceeding 10 million a year, 3% more on income above 25 million. Love it. Obama did something similar with higher income people when as part of the Affordable Care Act. One of the reasons it's so hated is there were by Republicans and conservatives is it taxed the rich more. It transferred about 20,000. The Affordable Care Act transferred about 20,000 from a typical top 1% family to give about 600 to a typical bottom 40% family. So it has significant inequality impact. This is another way of charging the super rich more. Let's hope it survives. So this is what Biden wants. So when people say, what does Biden want? Biden said, this is what I want. And he published it. And here's a New York Times article that covers it. That's the text version. And then here is the offsets. This is, again, the chart from Steve Ratner, I believe. But this is the where it comes from, how it adds up. Again, we'll see from the CBO where that is. But that IRS enforcement, international corporate profit tax, these are big numbers. These are over 10 years though, right? I do believe, yes. These are not annual. And here's another way of looking at it. Just in the White House plan, the Penn-Wharton budget model is it's not the CBO, but they are a group that will analyze budgetary legislation and give their views on it. Sometimes they'll beat the CBO to the punch because they'll just make different assumptions. The CBO has to wait for certain things, maybe the final legislation, whereas these other entities will analyze, frameworks and other things that require a little bit less rigorous inputs, and they come back to the table with this. So what they're saying, though, is the White House is being a little too rosy in terms of how much revenue they'll collect, but 1.5 trillion is still an awful lot and pays for 3/4 of it. So when Biden says, I'm going to pay for it all, if he pays for 3/4, great. Remember, the $2 trillion Trump tax cuts were not paid for at all. There was no bar here. The bar was zero. There was nothing to offset that hit to the Treasury. And here we're getting a lot of good stuff for people, and it's mostly paid for. This would be wonderful. And this is what progressives are after. The infrastructure is kind of a yawner for people that study it. This one is not. There is a lot of high impact stuff in here, and the more the merrier. Okay, I'm going to pause there for a second. Any questions on that? Let's take a look at the chat.
Obviously,
comment
all of
about
those
the
estimates we were
infrastructure?
just looking at are going to be replaced by the Congressional Budget Office estimates in the next couple of weeks.
Right. Yeah, and it'll be interesting to see, because wasn't there a small group of Democrats that are I don't know why they do this. They're like, we just want to see the CBO score before we do anything. Okay, fine. I mean, again, we're going to pay for 75% of this thing. Let's say we only pay for 50% of it. Let's say this thing's way off. Okay, it's still half of it paid for versus not paid for. And you've already seen the chart that Carl shared. Let's pretend for a minute that we pass this $2 trillion worth of, this is the revenue one. Let's go back up here. About $2 trillion in spending and investments. Let's say we pass the Biden framework kind of as it's set up. That's about the same size as the Trump tax cuts. That's $200 billion a year. Now remember, the budget deficit is going to get cut from the $3 trillion of the past couple of years down to 1.2-ish. So if that 1.2 becomes 1.4, whoop-de-doo. Okay, it's not that big a deal. Let's get this stuff passed. All right.
Yeah.
So
The House doesn't have a requirement to get a CBO score before voting on a reconciliation bill. The Senate does. So it's a question of, does the House want to send it over to the Senate before they know what the score is, or do they want to get the score so they can possibly modify it before it goes to the Senate and control?
I didn't know that. That's a great point. I didn't know that. The Senate has a requirement to review CBO scoring.
Yeah.
On a reconciliation bill.
Yes.
Awesome. Okay, I did not know. That's great. Okay. see, this is the cool stuff we learned here. Now, if you are trying to argue with your friends about how awesome Biden is, I tried to summarize this for you here in a couple different ways. This is sort of the left side is a list of some of the stuff you got. So when someone complains at the Thanksgiving table about they got nothing from Biden, say you got a $1,400 check. You're getting checks. If you got kids, you're getting $250 to $300 a month per kid. Again, that's an incremental number. It's sorry, the number is not that full size, but they're not going to know that. They were already getting the equivalent of some of that. I think it was $2,000 a year before. Now it's $2,500 or $3,000, somewhere in there. 3 million people with expanded ACA eligibility, 0 premium health insurance if you got UI, free COBRA for 6 months if you got laid off. No Republicans supported it. The troops are home. That used to be something that people on both sides of the fence liked. Yeah, we can argue that it wasn't smooth. You know, if you don't think it was smooth, go look at Vietnam, see how smooth that was. You can't leave a war because there's always going to be a crush at the end, I suspect. But we're out of there. COVID vaccinations, obviously we had just gotten the vaccine, but progress has been made. There's no reason to believe that we would be as far along as we are if Trump was fighting every step of the way to keep people from getting vaccinated if he'd won. So I think that number might not be 66 or probably more like 70 now if Trump had won again. And then we've talked about some of these economic statistics on the right. Biden up 620 a month versus Trump about 187. And that's 3 years pre-crisis. The unemployment rate. And so in other words, that's Trump during the good years. We're not punishing him for the post-crisis stuff. This is, and we're still in recovery.
4 years, he lost 60,000 jobs a month.
Right. Yeah, we're giving him kind of looking at him in a good sense, right, before the crisis hit. So the unemployment rate's been falling. The stock market is up. It's 37% up from the date of election. Because Trump was sharing that statistic. He was saying he should get credit because the stock market was doing well during that November, December, right after he got hired, after he was elected. Well, Biden had a big jump too. And the real GDP is higher. And so look at these statistics for a minute. COVID statistics, job creation, unemployment rate. Now you say that what happens here doesn't make a difference in the world, right? Okay, I took this chart and I put it everywhere on Twitter for a long time, including a lot of Biden's stuff. And take a look at this. Look at the statistics here. Job creation, unemployment rate, vaccinations, real GDP. He heard my cries. He used different numbers, made different assumptions. But there is no way that these 4 statistics are put into a nice presentation like this unless somebody saw this. I don't believe it. I choose not to believe it. So people do listen to us. Even the President of the United States sometimes hears our cries from here in the Chicago area and makes charts based on what we tell him. So whoever got to the president and told him, hey, you need to do this, he did it. So there it is. We are world famous, even though nobody knows about us. We are a top secret organization. A couple other things now for you guys to share. This was a great chart that the AP did the article, but it was a paper out of Hawaii. You can find this if you search for this, infrastructure images on Google. It'll tell you the article, but it was a nice way of looking at the infrastructure statistics. So I had that basic bar chart for you. Here's one you can share very easily. If you don't want to share the header, you can just clip out this particular piece right out of it and share it. Share this chart as much as you can when you're talking to people about how Biden hasn't made a difference. There's some nice solid results that you can share there. Here is I don't think Bill is with us. Is Bill here on the call tonight or no?
No.
I don't think he was. This is Bill's favorite chart, or his format of his favorite chart, used for the Biden boom. So it's basically the Biden chart, just a little bit, those Biden charts, just a little bit different format. Again, easy to share. And then you have some statistics about how horrible Republicans are for the economy, Twitter threads and articles. This is a nice New York Times article that summarizes this. And also there's a Wikipedia article about how much better the Democrats are on economic performance, with a whole bunch of citations if you ever need to go to the sources. This is where they are. And, these things are as simple as just cutting and pasting this into a browser and you can share it. So, use these charts. We've given you some good ones here. Spread them around. Use them to beat up on your relatives. When they come for Thanksgiving, you can have this PowerPoint ready to go for the Trumpers. But, again, as we've said here many times, those folks are generally beyond evidence. It's mainly for your edification and to try to motivate other liberals that may be getting discouraged by all the news about inflation. No, Biden's really not doing a good job, is he? I'm hearing all this negative stuff. It's like, well, no, Biden is actually, the economy is doing quite well. We have inflation because we have a huge boom going on. And people need to hear that more and more and more. The Biden boom is what's going on. And the Biden boom side effect is there's some inflation. That is the end of our prepared comments. I guess we're now into pizza hour and questions.
Well, I guess one of the things we have to figure out how to discuss is overall the economy is doing very well, but not everybody is doing very well. And how do we present that, the good news with enough empathy so you have a message that works for Democratic candidates, going into the midterms next year. And we can give that some thought, and we welcome suggestions from everybody in this room on that. Because, one of the things I don't want to have happen is like happened in 2014 or 2016 when leading progressive Democrats talked about everything that was wrong with the economy. The Republicans with a Democratic president are going to say the economy stinks. And the Republicans, the right-wing media are going to say the economy stinks. When Trump was in office, greatest economy ever. Biden's in office, the economy stinks. By any real terms, the economy was better under Obama and Biden, but that's their messaging. But the progressives back in 2014 and 2016, after 6 or 8 years of an Obama presidency, were talking about what was wrong with the economy and what needed to be fixed. And I heard them again last night with Bernie Sanders, Robert Wright, Stephanie Kelton, and one other person. And the message was, here's everything that's wrong. And if that's the message that a lot of people present, it's echoing the right-wing media message. And that's what people are hearing. So.
This group has the tools, and those of you that know how to use Twitter, you know how to use your email, you know how to send messages to your congressman, you have the facts, and I hope each person on this call does some of that. My chosen one, I work on Wikipedia, I work on Twitter. Those are my social media. Every now and then I will write a letter to our senators. Usually I don't write to reps sometimes, but usually the senators. Probably should write to our rep more. But take action. Don't just you now have more information about the economy than almost anybody. Carl and I make sure you do. And unless you are on the team of a professional economist, you have about as good the information as you're going to get. And you can always send a note to me or Carl asking for any tips, tricks, or other stuff. We are happy to look at those, but you've got the tool now. Use it.
I just stuck a copy of the PowerPoint link in the chat if anybody didn't have it otherwise. So copy that link so you can refer back to this if you don't have it already.
Go, Sarah.
Yep. So it's Sarah's retweets that are getting you all the coverage, David, and got us into the White House.
I do them at least 3 or 4 times. They'll come up again, and I'll keep retweeting them. Yeah,
He is my amplifier.
I put them everywhere, and especially with the charts. Yeah,
he's my only
all the
follower.
ones with the charts.
I'm close to 1,000 followers. If trends go on, I'll get there soon. But it's not millions, but 1,000 is a good start. So. That's my Twitter page is all economics all the time, pretty much.
Okay, so we asked for the schedule about the Cbl cost estimate. This is posted in the Cbo website the 9th, which was last week. Process of preparing the cost estimate. We anticipate releasing estimates for individual titles of the bill as we complete them, some of which they expect to be released last week, but others will be released this week. And so they said that when they figure out when they're going to have the entire bill, they'll provide advance notice.
It's nearly $2 trillion. That's not a trivial,
Correct.
trivial task.
Both
Yep.
whether the cost estimates are accurate and whether the revenue estimates are accurate.
I mean, it's bad enough
It's
to
the
try to do
scale.
it.
Yeah.
Oh, yeah. I mean,
Normally,
and
this
it's
is
so
done
many
over
different things.
dozens of bills.
And I
I mean,
stuck
just
one
to-
comment in the chat about how does, for next month's meeting, how's this Tuesday, December 14th look for people? Obviously, this group can make Tuesdays.